in the very kind of big picture sense, because of how much debt is in the system, the Federal Reserve has a really tough time raising interest rates. Basically, they lowered interest rates so much through so many cycles that they encouraged so much debt to build up in the first place. And so they kind of trap themselves into a corner where it's very hard to tighten monetary policy without basically burning everything down. And so they made a decision last year, before ever since 2012 or so, they've had this target of 2% inflation, the way they measure it, CPI. Actually, they use a similar metric to CPI. But anyway, they want to have 2% inflation. And starting last year, they talked about how instead of making that kind of a ceiling, they were going to kind of make that like an average. They wanted to purposely overshoot inflation and basically err on the side of continuing stimulus. And that kind of came back to bite them, I think, pretty quickly because they were hoping to get maybe 3-4% official CPI, and instead we have 7% CPI and still technically inching up here. And so the Fed, they were insisting that inflation was transitory, but once it started to hit those rather alarming headline levels, 30, 40-year highs, they changed their tune pretty quickly. They started talking about pulling back on quantitative easing, raising interest rates, and potentially even doing quantitative tightening. And the challenge is that they partially kind of missed their window because, if you look at, say, indicators of economic activity, right? So, for example, look at purchasing managers' indices. It's kind of a rate of change metric for what the economy is doing. When it's over 50, it means that basically it's expanding. When it's below 50, it's contracting, but it also gives us direction. So, for example, if it goes up to 60 and then falls down to 55, it's still growing, but it's decelerating. And generally, if you look at the purchasing managers index, see that the PMI over the long term, it looks like a sine wave that kind of bounces around 50, generally between 60 and 40, and sometimes you get these crazy spikes or dips. And so as we enter 2022, PMIs are rolling over. And these tend to have roughly 3-year cycles. I mean, you can have a couple different PMI cycles in in something that's defined as an economic expansion because you have these ebbs and these flows. And the problem now is that the Fed is looking to tighten into a decelerating economy by most indicators. And we had a similar effect back in late 2018, right? So when they were raising rates in 2017, they had the backdrop of rising PMIs. They had, the fiscal authorities were doing tax cuts on the horizon, so you essentially had a form of fiscal stimulus, basically cutting taxes without cutting spending, and so they had that kind of stronger environment to try to tighten into. But as that kind of dragged out to late 2018, they started to run into headwinds with that, and now they're kind of starting from a similar position, except they're just starting talking about tightening when PMIs are already rolling over. And so the market's throwing a fit, and then you add, geopolitical risks related to Ukraine, all sorts of, macro things out there, and it's a really tough time for them to, kind of continue on that track. And it's kind of an evidence of themselves painting themselves into a corner. So if you look after 2008, you had a massive amount of leverage in the system. So if you look at, say, the U.S. financial markets, if you look at total debt compared to the monetary base, it was a multiple of about 64. So you had 64 times as many claims on base money as there was base money. You could also look at broad money supply to base money. I forget the exact ratio, but it was pretty high. And then what they did in the 2008 crisis and in the aftermath is they mostly recapitalized the banking system. So they created new base money out of nowhere. They bought treasuries from banks, but then they also did, combining with fiscal authorities, they did the Troubled Asset Relief Program. And so they basically, help the banking system be more solvent. But what they didn't do is bail out homeowners for the most part. So there were minor fiscal stimulus packages, what we'd call minor today. I mean, it was several $100 billion. But basically, if you looked at, say, broad money supply, you had a destruction in loans, right? So you had a contraction of money supply, but then you also had stimulus. And so if you looked at broad money supply, it was roughly flat throughout that crisis. Basically, you wouldn't even know there's a crisis if you're looking at broad money supply. And so basically there wasn't like a ton more money in people's bank accounts chasing fewer goods and services. You had basically most people had less money. Many people lost their homes. They had to contract spending. There was high unemployment. In this cycle, there were a couple things that were different. One is that the fiscal stimulus was much larger and quicker right off the bat, and banks already went into this crisis well capitalized. They already had high amounts of reserves and treasuries as a percentage of their assets. And so they have other, there might be other challenges out there, but they weren't in the same situation they were in 2008. And so the goal wasn't to just recapitalize the banking system and not everyone else. It was more of that broad base, setting up like PPP loans that turn into grants, bailing out the airline industry, sending checks to people, doing childcare tax credits. Everybody, the majority of people had more money in their bank accounts. So broad money supply itself went up far more dramatically. It was the biggest spike we've seen since World War II, when you had a similar inflationary effect, by the way. And so this time it resulted in more money chasing, the same or fewer goods. Then you also add, supply chain issues, lockdowns, things like that. And another big factor that almost no economists pay attention to is the natural resource cycle. If you look at, they always focus on the demand side. They don't really focus on the supply side. And commodities go through these kind of like 15-year capex cycles roughly, where you have this period of oversupply. So you have super low commodity prices. Nobody wants to invest. And that's, they shouldn't be investing because it's just not, as you'd be destroying money. And over time, demand keeps going up over time, and then existing supplies get dwindled. You eventually get tighter commodity markets, and then you get a price signal, you get higher prices, and then it overshoots, of course. And then because there's a lag time between how you can bring more commodities online, money starts going into it, and it kind of works that self out. And so during that whole decade after the global financial crisis, we were in a period of structural commodity oversupply for the most part. You had demand destruction, and then you also had just, China slowed down. So all these copper mines came online during the whole emerging markets boom in the 2000s. And so suddenly we were kind of oversupplied on a global basis. And US shale oil brought a lot of new oil to the oil market, and destabilize that whole kind of supply demand balance that OPEC was trying to maintain. And so we had this period of oversupply, especially from the 2015 to like 2020 period. You just had oversupply of oil markets in particular. But a lot of that's worked out now. The combination of investors don't want to keep lighting their money on fire, so they're basically requesting more discipline from, say, shale oil producers. In addition, you have ESG mandates, things like that. So there's not a lot of excess capital going to energy capex anymore. It's been very low, and so now we find ourselves in a much tighter natural resource market. So the combination of faster money supply growth and then all sorts of physical constraints on supply give us a much more inflationary environment, I think, in this decade compared to the prior decade. I think they're going to err on the side of pushing their luck with more inflation. So I don't know exactly how far they're going to get with tapering, but I'm going to take the under for the most part, and think that, especially with the declining PMIs and basically overall deceleration, I think that basically they're overshooting their expectations somewhat. And there's a couple, it's more like, I think there are certain markets to look at. So a lot of people say, the Fed will never let stocks crash, but there's far more sensitive things they look at more than stocks. And so, for example, during the Q4 2018, downturn in markets, Powell had his famous Powell pivot, where they were talking about, their tightening policy was on autopilot. And then by the time you got to January 2019, he's like, just kidding, we're going to be data dependent, relax, guys, because you had everything crashing. And a lot of people have said, hey, look, it took a 20% downturn in the S&P 500 to make him change his tune. But the bigger thing under the surface, that was like the part of the iceberg over the surface. The iceberg under the surface was credit markets. So during that there was like a 6-week period where credit markets froze. No junk bonds were issued for like 6 weeks. And that's a much more severe problem for markets than just the S&P 500 going down 20%. And so that's the type of thing that makes them pivot. And so, just stocks going down 10, 20, 30%, Bitcoin going down, altcoins getting killed, these things are not going to make the Fed pivot on a dime. It's watching credit markets, and then it's also watching if the treasury market becomes illiquid like it did in March 2020. So those are the kind of the bigger pieces of the iceberg that would kind of force them to shift. In addition, if you started to see yield curve inversion, if you started to see actual recession risks rather than just deceleration risks, those are things that would likely lead the Fed to pull back, even if inflation's still above their 2% target. And so, it's been a while since they've had to choose between inflation, at least the way they measure it, and employment. So, normally they're bouncing back between their two algorithmic mandates, basically trying to maximize employment, trying to keep inflation, near their target, and usually choosing one or the other. Back in the 70s, they had both were problematic. And so Volcker chose to kill employment to try to stabilize the dollar. And I think now, and the difference was that they had a lot of problems back then, but they had low debt to GDP, partially because they had already been inflating it away, throughout the 40s and then throughout part of the 70s. And so they had low debt to GDP, and so they could jack interest rates pretty high without causing widespread insolvency. It caused a severe recession. It didn't cause like a depression. Whereas here, because you have so much debt in the system, I think they're going to err on the side of letting inflation run over their 2% target, and trying to jawbone it back down, trying to manage it around the margins, but still letting it run hot. And that's essentially what they did back in the 40s, which is the only other time federal debt to GDP was as high as it was now. I mean, we had these big inflationary spikes. You had price and wage controls, and they just held rates at zero for that entire decade, because they basically recognized insolvency. And so I think that's the framework going forward, but it's not necessarily a straight line. And so I think they're going to try to slowly tighten here until they get some of these signals that say you're stuck, basically, because kind of their third mandate is financial stability. So if the repo market breaks, if the treasury market breaks, if credit markets break, they're kind of forced back in to reliquify whatever market that was. And so that's kind of how I'm monitoring it.